Welcome back to the Deep Dive. Today, we were taking the scalpel to a company that sits right at the intersection of government policy, managed care, and some pretty high financial volatility.
We're looking at Molina Healthcare, ticker MOH.
And this is a fascinating case study.
It really is. Molina is, the ultimate government pure play insurer. They operate on a massive scale. We're talking, what, $38.6 billion in annual premium revenue as of year-end 2024.
That's right, serving about 5.5 million members.
Across 21 states, their entire existence, every dollar, is tied to these government funding streams.
That purity is precisely what defines both their risk and their opportunity. So for you listening, we're talking primarily about Medicaid, which is their bread and butter.
Right, but also supplemented by Medicare, especially those complex dual eligibles and, of course, the ACA marketplace.
So our mission today is really to evaluate the fundamental investment thesis here. Can this company's pretty demonstrated history of a massive turnaround in operational rigor, can that overcome the severe, truly unprecedented medical cost inflation that just slashed their earnings guidance this past year?
That's the billion-dollar question. The investment thesis for Molina has, historically rested on two pillars.
Okay.
First, their laser focus on this very specific, secularly growing healthcare sector. And second, the sheer operational discipline that's been hammered into the management team since 2017.
But that discipline just got tested.
It got stress tested in a big way. When you see the level of near-term earnings volatility they saw in 2025, a swing that cut their forecast by almost 50%, it just forces a critical reassessment.
So we have to figure it out.
We have to determine if this is a transient, industry-wide cycle issue that management can price through, or if this exposed a fundamental systemic weakness in their operational core.
Yeah, this is definitely not a stock for the faint of heart.
Not at all. We need to understand exactly what price a patient, long-term investor is paying for this specific brand of volatility.
Okay, let's unpack the journey then, because Molina's history is, frankly, far more compelling than most insurance companies.
Oh, absolutely.
It doesn't start with spreadsheets. It starts with a mission to serve a population that, pretty much everyone else was ignoring.
That's the key. The founding ethos is a critical non-financial asset that you can still feel in the company today. It was founded by Dr. C. David Molina, an ER physician, back in 1980 in Long Beach, California.
And he started it because he saw a real problem,
A
right?
huge problem. He saw that Medicaid patients often had nowhere to go for basic primary care, so they were flooding emergency rooms for things that a family doctor should have handled.
So that first phase, from 1980 to about 1994, was all about community-based care delivery through clinics.
Exactly. They started as providers, not insurers. The big shift, the first real pivot for the company, came when California decided to transition their Medicaid program to managed care to try and get a handle on ballooning costs.
And that forced Molina's hand.
It did. In 1994, they had to transition from just being a network of clinics to becoming a licensed HMO health plan. That's what established them as an insurer focused exclusively on capitation.
And for anyone listening, capitation just means they receive a fixed payment per member per month from the state to manage all their care.
Right. So phase two was all about expansion. The 2003 IPO gave them the capital to fuel this really aggressive multi-state growth into places like Utah, Michigan, Washington.
And they started diversifying a bit, too.
Yeah, around 2006, they moved into the Medicare space, specifically targeting those dual eligibles we mentioned earlier.
And then came phase three, the ACA era. And this is where it feels like ambition just completely outpaced their capability.
It was growth for the sake of growth.
No.
Rapid membership expansion. They got up to 4.2 million members by the middle of the decade. But looking back, it was growth completely without discipline.
Reckless, you might say.
I'd say it was reckless, frankly. And it led directly to that pivotal moment in 2017. The expansion, especially into the new ACA marketplace, was just plagued by terrible underwriting decisions.
They priced the plans way too low.
Way too low, based on totally inaccurate utilization forecasts. And on top of that, their back office infrastructure couldn't keep up. It was a mess.
So you had massive operational strain, high administrative costs.
They were lagging all their peers on efficiency metrics, and it all culminated in this dramatic, very public financial meltdown.
A crushing $512 million net loss in 2017.
That loss was the hammer blow. But the action the board took in response. That was the true inflection point for the company.
Right, because the board realized the company was just hemorrhaging money and, frankly, reputation.
So they removed CEO J. Mario Molina and CFO John Molina, the founder's sons, in May of 2017.
And they were public about why.
Very public. They explicitly cited disappointing financial performance. And you have to understand, this wasn't just a management change, it was a fundamental cultural shift
From that mission-first, family-run ethos.
to a shareholder-driven, margin-focused corporate discipline. It was a complete reset.
And the market reaction tells you everything you need to know.
Yeah.
The stock jumped 20% the moment that news broke.
The signal could not have been clearer. Investors were screaming that they prioritized operational efficiency and profitability over the continuation of the founding family's control.
The shareholders demanded discipline.
And they got it. They got it with Joseph Zubretsky, who came in late 2017 to start Phase 4, the big turnaround.
And his strategy was immediate and pretty painful.
Oh, it was brutal. He implemented something like 1,400 layoffs, which was a 20% cut to the workforce.
A huge cut.
And he executed a radical portfolio cleanup. That meant exiting unprofitable ACA markets like Utah and Wisconsin and selling off their non-core IT subsidiary for about $231 million.
When you lay off 1,400 people, you're not just trimming fat. You're fundamentally redesigning the operational DNA of the company. How exactly did he translate those cuts into a real financial revival so quickly?
It was a classic, brutal application of, zero-based budgeting principles to the back office. The layoffs weren't random. He targeted redundant administrative functions that they'd picked up during that sloppy expansion.
So by shedding those unprofitable state contracts and integrating everything else onto a single lean system.
The cost savings translated directly to the bottom line. The administrative ratio started falling sharply, and the company snapped back to profitability in 2018 with a $707 million net income.
A huge swing.
It proved that the underlying Medicaid business was fundamentally sound. You just had to manage it efficiently.
And that turnaround really established the template for Molina's future, what you call disciplined boldness.
Precisely. First, you stabilize the core. Then you prove the efficiency model. And only then do you pivot back to growth. But this time, it's primarily through accretive M&A.
And that's a critical distinction. The growth has to be profitable and scalable across that now lean administrative platform.
Absolutely.
So as we transition to the present day, the 2017 correction established that operational rigor, but it certainly didn't solve everything. What lasting strengths and, more importantly, what liabilities did that dramatic restructuring leave them with?
The primary strength is that deeply ingrained operational rigor and the lean cost structure. That's their new identity. They also managed to retain their legacy network moat in Medicaid, these long-standing relationships with community providers and state agencies that are just really hard to replicate.
But they were carrying some significant baggage into the modern era.
Two big liabilities. First, a history of underperformance in quality. A lot of their Medicare plans were stuck with star ratings below that crucial 4-star bonus threshold.
And just to clarify for everyone listening, why is that 4-star threshold so critical in the Medicare space?
Oh, it's the difference between modest profit and immense profitability. Medicare pays significant quality bonus payments. I mean, millions, sometimes hundreds of millions of dollars, to plans that get a 4-star rating or higher.
So if you fall below that,
you're just leaving a mountain of free federal money on the table. It also shows you're not quite proficient in managing high-quality, efficient care for your most complex members.
Okay, so that's liability number one. What was the second?
High geographic concentration. After the cleanup, they were really heavily reliant on just a few key states: California, Texas, Ohio, and Washington.
Which means if one of those states decides to cut Medicaid funding, or worse, switch contractors, it creates massive volatility for Molina.
Exactly. Which is why the M&A strategy, adding roughly $11 billion in revenue since 2020, was directly aimed at mitigating that state concentration risk.
They're buying their way into diversification.
Into states like New York and South Carolina, yeah. They took the operational efficiency they built in 2017 and used it as a competitive weapon to acquire and integrate smaller, less efficient plans, spreading their policy risk across a much wider map.
Okay, so let's look at the current business model. We've established Molina is a pure play, focused exclusively on government-sponsored care. How does that translate into their market positioning today?
It means they're hyper-focused. Medicaid is still the behemoth, making up a solid 68% of their 2024 premium revenue.
So they're not trying to become a big commercial insurer.
Not at all. They're a mature, mid-sized player, and their strategy isn't about pivoting into new markets. It's about what they call scale optimization and extension within their government niche.
So deepening their presence in adjacent opportunities.
Exactly. Things like dual-eligible special needs plans or DSMPs, long-term care, and winning new state contracts for different populations like CHIP, which is the Children's Health Insurance Program.
And the beauty of the model, at least when it works, is the simplicity of that revenue stream. Big, stable capitation premiums paid every month by government agencies.
But that stability relies entirely on policy consistency and, of course, winning your contract renewals.
And that consistency is really underpinned by the sheer scale of the market they're in. The total addressable market, or TAM.
Yeah.
It's huge.
It's gigantic. Managed Medicaid, the duals, and the ACA marketplace combine to exceed $750 billion a year. It's a massive, secularly growing market that is largely insulated from normal economic cycles.
Let's break those numbers down. So managed Medicaid is about $460 billion of that.
Right. The duals are about $150 billion, and the ACA marketplace is around $148 billion.
Yeah.
Molina is playing in a huge field.
But what's their actual penetration like? How much of that market do they have?
Well, their national Medicaid market share is pretty modest, only about 7%, which puts them fourth overall among the big national managed care organizations.
But that national number is a bit misleading, isn't it?
It is, because if you look at their footprint just within the 21 states where they currently operate, their average market share is significantly higher. It's around 11%.
Okay, let's run the numbers on that then. If Molina's 2024 Medicaid revenue was about, what, $26.3 billion?
Yeah.
And that represents 11% of the managed care spend in their existing states. That suggests their served available market, their SAM, in Medicaid alone is roughly $240 billion.
And that quantification is so crucial. It means Molina doesn't actually need aggressive, risky new state expansions to grow.
They can grow just by taking more share in the places they already know intimately.
Exactly. But the highest growth vector, the one everyone is focused on, is undeniably that dual-eligible segment.
The DSNPs. These are the people who qualify for both Medicare and Medicaid. They often have complex chronic conditions, maybe long-term care needs.
And this specific segment is projected to grow at an industry-leading compound annual growth rate, a CAGR, of approximately 10%.
And this is where Molina's small current footprint, only about 0.3 million members in duals, represents a massive upside.
Immense upside. If they can successfully capture a piece of that 10% market growth, they can transition these members from their Medicaid books, which have a lower premium,
to their Medicare books, which have a much higher premium and higher acuity.
Exactly. But it requires them to leverage their Medicaid expertise to coordinate really high-quality care. And if they can finally achieve those 4-star ratings here, the profitability explosion is significant.
So if the market is that big and growing, and the revenue model is straightforward capitation, this brings us back to the most important question. What is the competitive moat? What prevents rivals like UnitedHealth or Elevance from just leveraging their massive size to undercut Molina on price and steal their contracts?
The moat is deep, but it's not a brand moat or a technology moat. It's regulatory and efficiency-based.
Its foundation is that cost leadership and regulatory know-how we talked about.
That's it. Post-turnaround, Molina is arguably one of the most administratively efficient players in the entire sector.
Give us the hard number on that efficiency.
Their general and administrative ratio, their G&A, is down to about 6.7%.
And put that number in perspective for us.
While many of the larger diversified national players, they struggle to get their G&A ratio below 8% or even 9% across their entire enterprise.
So that efficiency gives Molina critical pricing flexibility.
It does. They can bid competitively on those capitation rates and still maintain their historical pre-tax Medicaid margin of 3 to 5% in a situation where a less efficient rival with 8% G&A would actually be losing money. Their efficiency is their profit engine.
That G&A advantage allows them to live on those thin margins. But what about the switching costs for the states themselves?
The switching costs are immense. The primary buyer, the state agency, is highly sophisticated and incredibly risk-averse.
They're managing very high-need, low-income populations where any disruption can have serious public health and, frankly, political consequences.
They value stability and proven performance above all else. So Molina's track record, which includes a 100% re-win rate on its incumbent contracts in recent cycles, that acts as a powerful barrier to entry.
So a new competitor has to prove they can handle the complexity of Medicaid.
And commit to the low G&A efficiency that Molina has demonstrated. It's a high bar.
So the state isn't just looking for the lowest price. They're looking for the lowest price that minimizes the risk of catastrophic failure for a very vulnerable population.
That is the delicate balance, exactly. You have to submit low-cost bids to win the contract, but you also have to deliver mission-critical service to satisfy the regulators and the members. Molina's 4-decade history serving this specific niche gives them a credibility that, competitors just can't buy overnight.
Right. Let's move into the operational mechanics. Unlike a retail insurer, Molina's demand is driven entirely by policy and procurement.
Right. They're responding to state RFPs, requests for proposals, and their 75% win rate on new Medicaid bids since 2020 really confirms their effectiveness in that highly technical domain.
It's a complex, multi-year process, right? It requires deep local network development and really robust utilization models.
Their success rate is a direct reflection of that operational rigor they built post-2017. However, the external membership flux is completely driven by macro policy.
And the big one recently was the structural churn caused by the public health emergency, or PHE, unwinding.
This is crucial because it directly affects the top line. During the pandemic, states paused all Medicaid eligibility checks.
Which led to artificially inflated enrollment numbers across the entire industry.
That's right. And now those redeterminations have resumed. States are systematically checking whether members still qualify for Medicaid.
And this process caused an industry-wide churn, hitting Molina's Medicaid enrollment by about 2.8% in the third quarter of 2025 alone.
Right. Now, management anticipated this, but it still represents immediate downward pressure on premium revenue. It means they have to successfully win new contracts just to stay flat.
And their strategy on the ACA marketplace is also very cost-conscious. They made the move to stop paying broker commissions on new enrollments in some areas.
Which is a very risky move in a highly competitive retail market.
So what was the thinking there?
It was a tactical, bottom-line focused decision to control their customer acquisition costs, their PACs. They chose to rely on external tailwinds.
Like the expanded federal subsidies, making plans more affordable.
And people losing their Medicaid coverage who then transitioned to the marketplace. They were hoping that would drive organic growth. And they did grow their marketplace segment to 0.4 million members in 2024. But that decision signaled that they prioritize LTV-CAC ratios over just raw enrollment volume.
This brings us perfectly to the unit economics, particularly in their core Medicaid business, where that LTV-CAC ratio is pretty spectacular.
It's incredible. The economics are so favorable because the customer acquisition cost is virtually minimal.
Because the state assigns many of the members directly to the plans.
Exactly. So Molina avoids all those expensive retail marketing campaigns and broker fees. We can impute their CAC at maybe $47 per member per year based on the administrative costs of onboarding.
Okay, let's use a hypothetical to make that LTV really concrete for the listener. If the average Medicaid premium is, say, $4,000 per member per year, or PMPY.
A reasonable assumption.
And Molina historically achieves a 4% pre-tax contribution margin on that. That's $160 in profit PMPY.
That's it. So if your CAC is $47, you earn back the entire acquisition cost in the first third of the year.
And since Medicaid enrollment, even with redeterminations, tends to be multi-year, maybe 3 years on average, the lifetime value, the LTV, is well over $400 in profit.
All against that initial $47 CAC. That LTV-CAC ratio is often well above 10-to-1. That is the bedrock stability of Molina minimal upfront cost for a sustained government-backed revenue stream.
But that bedrock was violently shaken by the 2025 cost surge. This is the moment where that operational discipline was truly put to the test. What precisely drove that unprecedented spike in utilization in Q3 of 2025?
The utilization spike was systemic, which suggests a market-wide failure in forecasting. And while the exact driver is always complex, analysts point to a few factors.
Okay.
A backlog of deferred preventative and elective care from the pandemic finally accessing the system all at once.
Right, pent-up demand.
Pent-up demand. Increased behavioral health utilization, especially post-pandemic, and crucially, the rising cost of complex specialty drugs, including that new generation of weight loss drugs, the GLP-1s, in some of their non-Medicaid segments.
And the impact was disproportionately severe in the marketplace segment, the one with a shorter LTV.
Right, where the medical loss ratio, the percentage of premiums spent on claims, it just soared to over 90%.
Which caused immediate crushing losses.
This one segment, which was initially expected to contribute a robust $3 per share to 2025 earnings, is now projected to lose approximately $2 per share.
Wow.
That $5 swing alone accounts for a third of the entire guidance cut. And at the same time, their core Medicaid MLR also rose significantly to 92%, which compressed those critical 4–5% core margins down to a razor-thin 1–2%.
And that forced management to slash their 2025 EPS guidance from an initial $24.50 all the way down to approximately $14. That's a nearly 50% drop.
This isn't just a tough quarter. This is an operational crisis.
It is the ultimate test of that disciplined boldness philosophy.
It is, and CEO Zabretsky's candor in calling it unprecedented was, I think, a way of establishing trust with the market. But now, the market is focused entirely on the immediate corrective actions.
Which are?
They filed significant rate increases for their 2026 marketplace pricing, and they are tightening utilization management protocols, so more prior authorizations, tighter network management, things like that, to try and get the medical cost trend under control.
But if they tighten utilization management too aggressively, isn't there a risk of alienating providers? That could potentially undermine that long-term network moat they've spent decades building.
That is the critical risk management tightrope they are walking right now. Aggressive prior authorization processes or claims denials that often leads to provider backlash.
And then the providers push back on the states.
They complain to the state regulators that the managed care plan is creating barriers to access for vulnerable populations. This could threaten their regulatory standing and jeopardize future contract re-wins.
So they have to restore profitability quickly, but have to do it surgically.
Exactly. They have to make sure the tightening only targets waste and unnecessary volume, not essential member care.
Despite this massive shock on the claims side, where is the silver lining in their operations? Is there one?
The silver lining is the administrative efficiency. The G&A ratio remains a fortress, holding steady at 6.7% in 2024.
So that confirms that outside of the claims volatility, their core execution on cost control and productivity is still solid. They're still running lean.
And that efficiency is the engine that drives their M&A strategy.
Right.
The acquisitions they've made, like Magellan, Complete Care, and Affinity, they were done at remarkably low multiples, around 0.22 times premium revenue.
And they can do that because they're buying plans that were probably inefficiently run by their prior owners.
That's the whole thesis. Molina's ability to immediately integrate those acquired members onto their highly efficient 6.7% G&A platform creates immediate synergistic profit where the seller was likely struggling just to break even.
So this M&A strategy really confirms that Molina uses its operational scale as a decisive competitive edge.
It's their weapon.
Okay, turning to the financial health of the company. Despite the 2025 turmoil, 2024 was actually a strong year. It showed 19% revenue growth and an impressive return on equity.
The 2024 performance was very robust, and the return on equity, or ROE, was approximately 27%. That is a massive figure, and it demonstrates extremely high capital efficiency.
Which is typical for an insurance business that requires pretty low capital expenditure. They don't have to build factories.
No heavy infrastructure. Their return on invested capital, or ROIC, is similarly strong, likely in the low 20% range.
Now, the market reacted very strongly to the earnings cut, dropping the stock pretty significantly. What context does this give us for the valuation?
Well, the stock fell about 20% right after that Q3 guidance cut. So, based on the /2025 EPS guidance of around $14, the forward price to earnings, or PE, ratio compressed to about 16 to 18 times.
And what is the market pricing in with that multiple?
Two things. Volatility, but also an implied recovery. If the market truly believed that $14 of EPS was the new permanent earnings power for Molina, the multiple would likely be much lower, maybe 10 to 12 times.
So the higher multiple suggests investors believe margin normalization by 2026 is still possible.
It's still on the table. And crucially, you have to remember the company remains conservatively leveraged. Their debt-to-capital ratio is around 35%, and they maintain an investment-grade rating with strong cash conversion that has historically tracked net income.
How disciplined is management when it comes to capital allocation? We know they don't pay a regular dividend.
Their focus is heavily on reinvestment, so strategic growth through acquisitions and maintaining sufficient regulatory capital.
But they did authorize a buyback.
They did a significant $750 million share buyback. But what's important is that they were patient. They hadn't executed substantial amounts of it as of early 2024 when the stock was trading near its historical highs.
And that delayed execution is actually a strong indicator of financial discipline. They weren't just using shareholder money to prop up the stock at inflated prices.
It demonstrates price discipline, which is rare, and their M&A track record reinforces this. They pursue these accretive, tuck-in acquisitions that strategically expand their footprint into places like New York, Wisconsin, and South Carolina.
But you could argue that the 2025 cost surge was, in essence, a failure of risk capital allocation. They priced plans too low, allocating capital to a high-risk portfolio that ultimately failed to deliver.
I think that's fair. It was clearly an oversight, especially in the marketplace segment, regarding the velocity of the medical cost trend post-pandemic.
So what does that say about their forecasting ability?
It says it's not perfect. However, their immediate and aggressive course correction filing those significant premium hikes for 2026, it shows management adaptability. They are willing to quickly sacrifice short-term market share for the sake of margin recovery.
Which validates that long-term, margin-first mentality established back in the 2017 turnaround. Okay, let's assess management and governance quality. The 2017 board action was the ultimate test of independence. How does the current team under Zabretsky score?
The current team is highly rated. We'd score them strong across strategic vision, operational execution, and financial management. The independence of the board was proven when they removed the founder's family.
And the incentives are aligned.
They are. Executive compensation is correctly aligned with profitability metrics like ROE and adjusted EPS, which ensures they prioritize shareholder value creation over just simple top-line revenue growth.
And the CEO's response to this recent crisis?
His candor was vital. By transparently calling the cost spike unprecedented and quantifying the specific earnings impact, he reinforced investor trust, even while delivering devastating news.
In a sector often criticized for obfuscation, that transparency is a pretty significant positive governance sign.
A huge positive.
All right, let's move to the forensic review. When a company experiences a near 50% guidance cut, auditors and investors, they immediately start looking for accounting red flags. What did the review uncover?
Structurally, the accounting appears clean. There have been no major restatements or questionable policies noted.
The business model is pretty straightforward.
It is, and their non-GAAP adjustments are minimal. It's mainly just the amortization of acquisition intangibles. And as we said, cash conversion historically tracks net income closely, which is always a positive signal of earnings quality.
What about regulatory risks beyond just pricing errors?
Well, they operate in a highly scrutinized environment, so minor regulatory issues do occur. We saw, for example, a $1 million fine in California in 2022 related to provider payment delays.
And a smaller one in Washington.
Right, for some enrollment system glitches. These are typically operational growing pains you see after integrating acquisitions. There's no evidence of systemic compliance failures or widespread fraud that would jeopardize their ability to win state contracts.
And the inevitable securities class action that was filed after the steep stock decline.
That is pretty much procedural at this point. Our analysis suggests the drop was genuinely driven by a market-wide cost surprise that management failed to forecast correctly. It was an execution surprise, not malfeasance.
Finally, let's address the core macro risk, the one that Molina absolutely cannot control, but which could drastically alter the entire investment thesis.
Political policy risk.
This is the overarching threat for any pure-play government insurer.
It's their heavy reliance on federal and state Medicaid funding consistency. The major red flag here involves potential large-scale federal Medicaid funding cuts, often associated with policy proposals referenced in analyses of proposed legislation like H.R. 1.
How exactly would a proposed policy change, like, say, block granting federal funding, impact Molina?
It would be catastrophic for them. Currently, states receive federal funding based on how much they spend. It's a matching program.
Right.
If the federal government shifted to a block grant model, it would cap federal spending, forcing states to absorb all the cost growth themselves.
And to control those costs, states would inevitably have to tighten Medicaid eligibility requirements.
Kicking millions of people off the roll.
Or severely reduce provider payment rates.
Exactly. Molina's own management has modeled potential membership hits of 15% to 20% if such deep cuts were ever enacted. Now, while the political climate currently resists such drastic changes, that specific political risk is the single largest existential threat to their entire business model.
So let's bring this deep dive to a close by synthesizing the three major themes we uncovered. First, let's recap the resilience factor.
The historical context is invaluable here. The aggressive post-2017 restructuring and turnaround, it proved Molina's institutional ability to correct course swiftly and decisively. They prioritized margin over reckless growth.
And that institutional learning provides a strong basis for believing the company can navigate the current cost environment.
I think so.
Second, the strategic focus. That remains a powerful secular tailwind.
Absolutely. The pure play strategy leverages the long-term secular growth of managed government healthcare, particularly the rapid expansion of the complex dual-eligible special needs plans, the DSMPs.
As the population ages, the number of Americans qualifying for both Medicare and Medicaid is only going to grow.
It provides a sustained, multi-decade growth lever right in Molina's specialized sweet spot.
And third, the inescapable operational challenge that was presented by 2025.
Yeah, 2025 is a painful billion-dollar reminder that thin margins, which are just inherent to a low-cost contract model, mean extreme volatility when your pricing and your utilization are misaligned.
It's the high-volume, low-margin business.
Which means small forecasting errors in medical costs lead to these outsized, sudden earning shocks. The ultimate health of the business rests on management's ability to execute a quick and sensitive margin restoration.
So considering the volatility but also the strength of the operational team, what's the final investment conclusion for a long-term holder who's looking past this current year?
I think Molina is investable, but, and this is a big but, only for long-term holders who are fundamentally comfortable with the policy and execution risk that is inherent in government contracting.
You have to be willing to stomach the swings.
You do. The strength of the current management, that fortress-like G&A efficiency, and their solid capital position, they provide a critical cushion against what appears to be a transient industry setback.
So the seat market pullback might be an opportunity.
It has arguably presented a potentially attractive entry point relative to Molina's long-term earnings power, provided, and this is the key, that the market sees definitive evidence of margin normalization by the end of 2026.
And what are the absolute key triggers that investors must watch closely over the next 12 to 18 months to validate that assumption of recovery?
3 things. First, you need to see evidence that the medical cost ratio, the MCR, is stabilizing or trending down in Q4 2025 and throughout the first half of 2026. If the utilization spikes continue, the thesis is fundamentally broken.
Okay, number 2.
Successful repricing of the marketplace plans for 2026. We need confirmation that the significant rate increases they filed are approved and that they're sufficient to restore profitability in that volatile segment.
And third,
flawless execution on the integration of new state contract wins. Those are vital to offset the structural membership losses caused by the Medicaid redeterminations.
fascinating. So I'll leave you with a final thought. Given this highly specialized niche, the relentless operational efficiency and the scale advantages that Molina has painstakingly built since 2017, is the company's ultimate destiny less about slow organic growth and more about becoming an indispensable, highly priced acquisition target for one of the larger, diversified insurers that's desperate to dominate the Medicaid sector?
That is the enduring strategic question. Molina is too large for most rivals to swallow easily, but its perfect pure play focus and that industry-leading administrative efficiency. It makes it the ideal, highest-value tuck-in acquisition for a global behemoth like UnitedHealth or Elevance.
And if the right price were offered.
Combining Molina's lean G&A backbone with a larger player scale could unlock immense value. The 2017 board already proved it is willing to make the ultimate move to maximize shareholder value. If this turnaround continues, selling the company itself could be the final, most lucrative realization of the Zabretsky era's focus on margin.
That's the premium shareholders are ultimately hoping to realize.
That's the end game.